Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at a semiconductor stock out of Taiwan. And this stock is HIMX Technologies, ticker HIMX. It was a requested stock and I'm seeing some interesting things when I'm looking into it. So let's get right into it and see what's going on here. So for our projections, we'll get to the actual details of this, but we're seeing a fair value right around $11. Margin of safety of 25% because there's a little bit more risk to this. $8.30 and a high, so it'd be overvalued in the $12 range. And over the last 52 weeks, we've seen it go all the way down to 481, as high as 870, and it's currently sitting in the $5 range at $5.41. Discounted cash flow, we're coming up with 385, likely due to the pretty low starting cash flow yield and growth. But we are seeing here the actual high for the last 52 weeks is right about our margin of safety. So it is looking like it's an undervalued stock. Now we need to see if it's consistent and it is able to perform. And then we'd see, is it really at a good price right now? Earnings yield looks pretty good, 21.9%. They just need to come in with 27 cents because of how low the stock price is. And that's something that I'm seeing across the board on this stock is it is a very low PE, especially for the growth they're putting up. We're seeing PEs in the 4s, the 6s, and they're putting up 21% revenue growth year over year, 16.36 over the last 2 years. So there's quite some growth on the top line that's coming in, and that's not really accounted for in this PE. Cash flow yield, their starting cash flow is okay, 5.89%. It's growing 8.91% year over year. That's some decent growth. We do like to see at least that. I'd say that's not bad. Nothing incredible. Dividend yield, they didn't start paying a dividend until more recently. 2021 was the first year that they paid a dividend. It was 27 cents. Last year, for the full year, it was 125. We're expecting 48 cents this year. So next year, who knows? That's why we're just going with 50 cents. Seems pretty reasonable. So that's giving them a pretty high yield to start right now. Last year, they had an incredible yield of, and then the payout ratio, that is a very high payout. 90, almost 92%. So I don't see that dividend raising. It looks like they are just paying out what they feel like they can afford to whenever they can. ROE looks pretty good, 26.55. We like it above 20, and that means we need to take a look at the debt to equity. And this is below 1. It's a little high, 0.91, but it's below 1, so we can count this ROE as a check mark, green box. And it seems to be growing pretty well. Gross profit currently at 40.55%. The average over our time frame is 33.59, so it looks like they are growing their gross profits. Net profits, same story, 19.73, and the average is 12.81. So we do see some good growth there. Revenue growth, as we discussed, 3-year 21%, 2-year 16%. Analyst projections, not great though. They're expecting a 21.5% decline this year and another 7.4% decline the following year. Earnings per share, a little all over the place. And it could be due to where we're starting out with the earnings per share. But going forward, based off this year, expected to come in 5% lower than last year. And next year would be 8.5% higher than this year. Cash flows, we do see some negative trends there, so we'll get into that. The share count, they have been growing their shares. That's not something that I really like to see. Assets are growing pretty quickly. Liabilities essentially on the same pace. Dividend, well, they didn't start paying it until more recently, so that first number is not quite there. And that covers a lot of what we look for here. And we can see everything graphed out to really get a good idea of the trend. I don't know. To me, the revenue looks pretty flat. It's pretty low revenues compared to some of the other companies that we've looked at. So a smaller increase is still massive to them. And we do see it peaked in 2021, a bit of a downtrend expected to jump back this next year. And we see almost the exact same graph for the gross, net, and EBIT. So it looks like their margins are pretty standard and might be improving a little bit year over year. That balance sheet, great asset growth. Tangible assets are growing as well, which helps to give us a tangible book value higher than the liabilities, something that I really like to see. And the liabilities are growing very quickly in the future if they continue on the pace that they have been. It's almost indistinguishable between the assets and the liabilities here. Cash flows. Let's see how consistent the cash flows are. 2019 was a negative. We don't like to see negatives within the last 3 years, so they get away with it there. 2021, again, was an exceptional year, and we're showing small incremental growth year over year from 2022 forward. Dividends, they didn't start until 2021. Huge year in 2022, and hopefully they can at least hold at this level going forward. And then the actual price graphs here. We're looking for the current share price sitting right here. Typically, it's where we want it to be. Right here, smack dab in the middle in 2021. Maybe it was a little low in 2022. Was overvalued for sure in 2020. And pretty high on the valuation as well in 2019. But where it sits today, definitely see some upside based on all these valuations. The question is, do we see consistency here? So the lowest, at least in 2020, was the dividend, which was non-existent. So we do see a peak in 2021. We see all of those peaks in 2021, and then things have kind of settled back down as of 2022. And going forward, we see some just slow growth coming out of everything. Looking at everything, it's honestly not too bad. We do have a decent ROE. PE definitely looks low. Debt to equity looks pretty good. One concern would be the share count growing, and we can see the actual magnitude of that. 344, 347, 348, barely anything in 2022. So it looks like they might be slowing it down, and that's a good sign. So I give that a yellow flag. And earnings yield looks incredible, just like the PE looks very low. And I definitely, based on everything we're looking at here, I don't think that $9 would be unfair for the stock. Not at all. And one issue is the analysts' expectations going forward. We were seeing some declines. So 2022, $1.36 in earnings, expected to be $1.29 in 2023, $1.60 in 2024. So 2024 is showing some growth over last year. And that's what we're looking for in a lot of the companies we've looked at recently. We're seeing that 2023 is a down year for them. And as long as they're expected to bounce back, it could pose as an opportunity to buy. Revenues. See, we're seeing revenues expected to drop back down below. 2021 was a great year for them. So it puts them above 2020, but definitely one of the lower of the time frame that we're looking at. And even if they're able to bounce back in 2024, it's lower than what they're coming in last year. So that is one concern there, is the slowing revenue growth. They need to be able to push that more. They need to hold something in the double-digit growth range, especially for a share at this price level. So it's definitely going on a watch list. I'm leaning towards a buy because it's got a lot of good things going for it. Some of the bad things can definitely change pretty quickly. So we'll put it hold to buy. So a loose buy rating. And we'll see how things play out. But I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there is any other stock that we should take a look at. And subscribe so you can stay up to date with everything. And I'll catch you next time.